Florida's real estate boom was meant to be invincible. Home prices doubling, 330,000 new residents flooding in, and the governor declaring victory. But as buyers walk away from deals at record rates and insurers collapse overnight, panic has reached the governor's office. Massive insurance failures, skyrocketing premiums, and a 61% surge in unsold homes are hitting Miami hardest, exposing just how fragile the American system really is. Now, the exodus has started, with luxury buyers forfeiting $18,000 deposits and experts warning that Florida is only the beginning. If even the governor of Florida panics after buyers walk away from home sales, just how close are other U.S. cities to facing the same fate? Sun, palm trees, and a line of moving vans stretching across I-95. In 2021, South Florida became the finish line for America's Great Migration. Nearly 330,000 new residents swapped snow for sand that year, pushing Florida's population past 22 million. Miami-Dade and Palm Beach counties saw their fastest growth in a generation, with Broward close behind. The median home price in key zip codes doubled in just 30 months, turning modest bungalows into million-dollar listings. In Boca Raton, a three-bedroom that sold for $480,000 in 2019 closed at $975,000 by spring 2022. Realtors fielded offers sight unseen, sometimes from buyers who'd never set foot in Florida. Sellers set deadlines, buyers waived inspections, and bidding wars became the new normal. From Coral Gables to Jupiter Island, Governor Ron DeSantis, never one to miss a headline, called it paradise on the rise. But beneath the glossy listings, the cracks were starting to show. 6 insurance carriers failed in Florida since 2022, leaving hundreds of thousands scrambling for coverage as hurricane season began. On a single day in October, 3 insurers were seized by state regulators, sending shockwaves through the closing tables of Miami and beyond. The average homeowner's policy now costs $6,291 in Broward and $6,170 in Miami-Dade, more than double the national average. For many, insurance isn't just a line on the closing statement anymore. It's the wild card that can break a deal or break a budget. Buyers expecting a routine closing found their policies canceled with just 48 hours notice. Sellers watched as contracts dissolved, deposits vanished, and agents fielded frantic calls about last-minute premium spikes. The private market's retreat forced a mass migration to Citizens Property Insurance Corporation, the state-run backstop designed for emergencies, not everyday business. But Citizens itself is overloaded, carrying more than 1 million policies and warning of its own limits. Confidence drained from the market. Deals collapsed overnight and buyers vanished. The insurance crisis wasn't just a background risk. It was the first domino, toppling the illusion of endless demand in Florida's Sunbelt boom. Mortgage math has turned brutal in South Florida. A 30-year fixed loan on a median-priced home now runs more than $2,100 a month, double what buyers faced just 3 years ago. That extra $1,100 isn't a rounding error. It's the difference between qualifying for a starter home and getting locked out entirely. Nearly 41,000 homes now sit unsold across the Tri-County region, up 61% from last year. Pending sales have slipped 11% in the first quarter of 2025, and the average time on market hovers near 60 days. For every new listing, fewer buyers show up, and those who do demand concessions, rate buydowns, prepaid insurance, even roof repairs. Sellers who bought at the 2022 peak must choose: cut the price, offer cash at closing, or watch equity vanish. The liquidity equation is simple and unforgiving. With higher rates, surging inventory, and buyer retreat, the market's gears have ground to a halt. The American system that once promised endless upward mobility now leaves sellers stranded and buyers on the sidelines. August 24, 1992. Hurricane Andrew made landfall in Homestead, Florida, with winds topping 165 miles per hour. Whole neighborhoods vanished in a single morning. More than 28,000 homes, mobile homes, and apartment buildings were reduced to rubble. Another 107,000 dwellings suffered major damage, leaving over 180,000 Floridians without a roof. The storm's path carved a scar through South Dade County, roof trusses scattered like matchsticks, streets littered with shattered windows and mangled garage doors. Insurance companies buckled under the weight of $27 billion in claims, a figure that would top $76 billion in today's dollars. 11 carriers went bankrupt within months, and thousands of families waited years for settlements or repairs. For a generation, Andrew was the yardstick for catastrophe, the moment when Florida's promise of sun and safety turned overnight into a warning about risk. The rebuilding effort changed the skyline, but it couldn't erase the memory of entire blocks erased in hours. Every time hurricane season returns, that memory hovers over the closing table and the insurance adjuster's clipboard, shaping the price of every policy and the fear behind every premium hike. Andrew's shadow stretches across every new home, every condo tower, every insurance quote, reminding Floridians what's truly at stake when the wind picks up and the sky goes dark.
SB 4D landed like a thunderclap in Miami's condo towers. After the Champlain Towers South collapse, lawmakers demanded sweeping change, mandatory structural inspections, ironclad reserve funds, and no more waivers for expensive repairs. Over 16,000 condo associations, covering nearly 1 million units, were swept into the new regime. For board members like Ana Morales and Brickell, the numbers were staggering. Her building's first reserve study called for $5.2 million in repairs and upgrades, with every owner facing a special assessment of $48,000. In buildings with deferred maintenance, assessments soared past $100,000 per unit. Some owners, retirees on fixed incomes, received letters warning that failure to pay would trigger foreclosure. Monthly HOA fees doubled or even tripled, with no guarantee the bills would stop there. The new law required milestone inspections by licensed engineers every decade and full funding of reserves for roofs, plumbing, and structural systems, no exceptions. Banks and mortgage underwriters demanded proof before approving loans. Buildings that missed deadlines or failed inspections lost access to FHA and VA financing, instantly shrinking the buyer pool. Agents watched as listings lingered, buyers evaporated, and unit prices slid by tens of thousands with each passing month. In some complexes, half the owners tried to sell at once, only to discover there were no takers. The liquidity that once defined Miami's condo market froze in place. Investors who had snapped up units for rental income now faced negative cash flow and mounting losses. For board members, every meeting became a crisis session, debating which repairs to prioritize, how to collect from struggling neighbors, and whether bankruptcy might be the only way out. The promise of safe, affordable condo living had been rewritten as a cautionary tale, one where regulation, market risk, and financial pressure collided all at once.
Institutional investors once treated Florida's housing market as a bottomless ATM. By early 2023, that confidence had evaporated. Hedge funds and private equity groups, including names tied to Blackstone and Invitation Homes, quietly began offloading thousands of single-family homes and rental condos across Miami, Tampa, and Orlando. Internal risk memos, later surfaced in industry reports, warned of cascading defaults if the volatility persisted. The sell-off wasn't a trickle, it was a flood. In the first half of 2023, entire portfolios hit the market, with some funds liquidating hundreds of properties in a single quarter. These weren't fire sales by desperate families. They were calculated exits by firms who saw the writing on the wall: insurance chaos, mortgage math, and a buyer pool shrinking by the week. The withdrawal of institutional money yanked away the last price floor. Without investors competing for inventory, listings piled up, and sellers lost their only leverage. The American system, designed to reward capital mobility, let the biggest players walk away with profits banked and risk dumped on the locals left behind. Meanwhile, reinsurance costs for remaining carriers soared, up 40% to 100% in just 3 years, forcing even more insurers to hike premiums or abandon the state altogether. For ordinary homeowners, this meant a new round of cancellations and skyrocketing bills, while for Wall Street, It meant a clean break and fresh capital for safer markets. Behind the scenes, construction lobbyists pressed lawmakers to delay stricter building code updates, arguing that immediate compliance would cripple ongoing projects. Their influence bought time, but at a cost. Every year of delay gave insurers more reasons to raise rates on older buildings and buyers more reasons to walk away. The result? A market stripped of its safety net, with institutional investors gone, regulatory fixes stalled, and the burden falling squarely on everyday Floridians. As one investor spokesperson put it, "We're not in the business of catching falling knives." For the families still holding the blade, there was nowhere left to turn. In Miami Beach, luxury towers once boasted waitlists and all-cash offers. By winter 2025, 40% of high-end condo deals were abandoned before closing. Buyers didn't just hesitate, they walked away, even if it meant forfeiting deposits worth tens of thousands. The number was staggering. Nearly 2 out of every 5 contracts in flagship projects like the Miami Wave residences fell apart in a single month. Agents called it a wave of ghost buyers, with empty units stacking up and developers slashing prices just to keep the lights on. For families like the Alvarezes in Pinecrest, the collapse wasn't theoretical. They lost $18,000, every penny of their savings, when their insurer canceled coverage days before closing. No backup plan, no refund. The dream home they toured with their kids became a cautionary tale overnight. The Alvarezes joined a swelling crowd of would-be buyers who watched their contracts dissolve, their deposits vanish, and their hopes for stability wrecked by forces far beyond their control. Across Miami-Dade, sellers faced a new reality. Walkaway rates soared, leaving behind zombie listings and a market flooded with unsold homes. The American promise of homeownership, once a ticket to security, had turned into a high-stakes gamble. With every abandoned deal, confidence drained from the system, and the question grew louder: if buyers won't stay, who's left to catch the falling market? Governor Ron DeSantis stood at the podium, promising stability as headlines blared about record home sale cancellations and insurance chaos. But behind closed doors, the mood was anything but calm. In May 2023, internal emails circulated among top aides, showing a scramble to contain the fallout as donors and industry allies demanded answers. Calls flooded Tallahassee from realtors, builders, and campaign backers, all asking the same question: what's the plan when buyers keep walking away and insurers keep folding? Briefings painted a bleak picture. Walkaway rates in Miami topping 20%, with thousands of contracts collapsing in a single quarter. Donor calls grew tense as the administration tried to reassure supporters that reforms were working, even as local officials reported cascading foreclosures and empty towers. Publicly, the governor repeated claims that the market was strong and reforms were underway. Privately, his team weighed emergency meetings with insurance executives and construction lobbyists, desperate to stem the tide before the next election cycle. The gap between official optimism and private alarm widened by the week. As buyers vanished and prices tumbled, the governor's office faced mounting pressure to deliver real relief, not just press releases. The American system, built on the promise of endless growth and private risk, left the state's top official cornered, caught between political donors demanding action and a public watching their wealth evaporate. The warning signs flashing in Florida's housing market were no longer just economic. They were political, and the panic was spreading from kitchen tables to the governor's own war room. By 2026, the American insurance system faces a reckoning that stretches far beyond Florida's borders. Actuarial models now warn that as many as 1 in 5 Florida homes could become functionally uninsurable within the next 18 months. Already, more than 15% of properties in Miami-Dade and Broward counties have lost access to affordable coverage, with some owners forced to go uninsured or rely on surplus line carriers at triple the cost. The state-run Citizens Property Insurance Corporation, designed as a last resort, now carries over 1 million policies and warns it cannot absorb another major storm. In coastal neighborhoods from Tampa to Fort Lauderdale, the word uninsurable is creeping into listing descriptions, turning once prized homes into financial dead ends. This crisis is not contained. National carriers, battered by billions in hurricane losses and relentless litigation, have begun refusing new policies in other coastal states. In Texas, Louisiana, and even parts of New Jersey, buyers discover that insurability, not just price, now determines whether a deal can close. Local officials scramble for patchwork solutions while federal backstops remain political mirages. The American model, fragmented, profit-driven, and reactive, offers no safety net as climate risk and financial stress compound. If Florida's trajectory holds, entire zip codes across the Gulf, Atlantic, and Pacific coasts could soon face the same fate. Homes that cannot be insured, mortgages that cannot be written, and neighborhoods left stranded by a system that promised security but delivered only exposure. The warning is clear. What began as a Florida emergency now flashes red for the rest of the country. The collapse of insurability is not a local storm, but a gathering front threatening to sweep across the map, city by city, state by state.
In 2023, 40% of luxury homebuyers in Miami walked away from their contracts, losing deposits as high as $18,000. This dramatic reversal followed years of soaring prices and record migration, only to be undone by surging insurance premiums, new condo assessment laws, and a retreat by major investors. Documents confirm 3 insurers were seized in one day, and internal government briefings revealed mounting panic over the market's unraveling. Yet, crucial details about Governor DeSantis's private response remain undisclosed, and the true extent of future insurance losses is still unclear. Today, more than 41,000 homes sit unsold, a 61% jump in inventory, while Florida's market instability now threatens to spread to other states. The evidence shows this is not just a local crisis, but a warning about the wider American housing system's fragility. The facts are public. How leaders and institutions respond remains the unanswered question.